It's here. The new rules for real estate commissions and how the real estate industry operates as a whole. The changes have taken effect. It was August 17th. So we're going to talk about all of that today. How does that affect the market and what can you expect as a buyer or seller? We're also talking about the record number of homes worth $1 million or more that just came out, as well as the number of investor purchases that we're seeing going up. So what's going on with that nationally as well as Phoenix? Let's get into it. So let's start with the juicy news. You can't not see this everywhere at this point. So here's an article from Yahoo Finance. Buying a house just got a lot trickier. So this is talking about the perspective of the home buyer and how the home buyer may have to foot the bill for the real estate agent commission in order to buy a house, and how that is going to be challenging for many home buyers and possibly not even possible depending on the situation. I'm not going to go through this article because I can just tell you what's going on. So here's the deal. If you're not familiar with what has happened and the changes that took place on August 17th, these changes took place nationally. Every state has their own real estate MLS and actually multiple MLSs, and each one might have slightly different rules, but bottom line, all of these changes took place due to a lawsuit settlement that came out earlier this year. And the way the industry has changed is that, number one, buyers have to enter into a written agreement with a real estate agent to see any property. So even if you just want to see one house, you have to have a written agreement with that agent to be able to gain access to the property. Number two, real estate agents are no longer able to advertise what we called co-broke commission, so sharing your commission as the listing agent with the buyer's agent on the MLS. And really, the point of this lawsuit was to decouple these commissions and not have them be shared between brokers. So that is still allowed technically, but really in today's world, what should be happening is the listing agent has a fee that is negotiated with the seller on what they will pay them to sell the house. And then the buyer agent fee is completely separate from that. And I'll get to that in a second. But you can't advertise buyer agent commissions in the MLS any longer. That field is wiped away entirely. So as a buyer's agent, how do you know if you are going to get a commission from the seller? Well, you have to call the listing agent and find out. And what is happening now is most sellers are saying, I'll consider it based on the offer that you provide. So although this rule was supposed to be creating more transparency, there's a bit less transparency in my opinion now, because no one knows if there is compensation offered, and all that compensation is really just determined based on the terms of the offer. So those are the two main changes. The other thing that changed in this is that sellers don't have to offer compensation at all. Now, compensation was always negotiable, although many people didn't feel like it was. There was no set standard as far as you had to pay X amount. Various agents had their fees that they charged, and maybe they weren't willing to negotiate on it, but there were other agents who would. So it was always negotiable to the consumer, although part of the reason this is an issue is because the consumer did not understand that. So previously, you could pay as little as you wanted to a buyer's agent. Now, that doesn't mean that it would be in your best interest, because of course people work based on incentives. So those buyer's agents are more likely to show your property if you're offering a larger fee to them. But the things that have changed with today is actually you don't have to offer any compensation at all to buyer's agents. Previously, at least in Arizona, you had to offer at least $1. So at this point as a seller, you have that right to not offer any compensation. So how does this work as a buyer? You're probably sitting there like, well, what the heck? How is my agent supposed to get paid? Because in the past, the buyer's agent never paid them directly. Now you can argue this is all semantics. You can argue that, buyers always ended up paying anyway because the inflated price of the home, whatever you want to say. But buyers agents were never expected to pay with their closing costs at close of escrow. And in today's world, that is a likely situation. So there's a few ways that buyer's agents can get paid if they are representing you as a buyer. First of all, they can ask the seller to compensate them. And that is a very common thing to see as we have started this change. They can also get compensated by some combination between you as the buyer and the seller. They could also be compensated directly from the buyer. Obviously, that's an option. Or there could be a seller concession negotiated into the contract. The buyer can use that seller concession to pay their agent. At this point in time, there is no option for this to be rolled into the loan. There are Fannie and Freddie guidelines that aren't allowing that. I don't know if that will change. There has been discussion around that. But at this point in time, as a buyer, you cannot pay your buyer's agent by way of financing that into your loan. So is this good for the industry? Is this bad for the industry? Good for buyers, good for sellers? There's a lot of questions out there. And to be honest with you guys, I think it's going to take us at least a year or more to find out how a lot of this shakes out. I can speak from my standpoint of talking with other real estate agents and just seeing a lot of the thoughts and feelings out there. There's a lot of confusion. Unfortunately, there's a lot of agents out there that don't fully understand this, maybe miscommunicating it to the consumer, unfortunately, or with one another. And as we are interacting with other agents out there in these transactions, if you're representing the buyer and you're interacting with a listing agent, a lot of people aren't seeing eye to eye because they don't really understand it fully. So I think there's going to be a little bit of kind of a shaky time period here as we flush out all of this stuff and how it will begin to work. But my advice to you as a buyer or a seller is to make sure you're asking all of these questions to your real estate agent. Ask them how it works, what they would recommend, and what the pros and cons are for you, depending on which position you're in. A lot of this was meant to decrease commissions across the board. Whether or not that is going to actually happen from these changes, it's hard to know. But of course, that was one of the intentions of this change, as well as hoping that home prices decrease. I had seen many articles out there about home prices coming down because sellers won't have to pay as high of commissions. But realistically, do you think sellers are really going to discount their home price just because they feel like they're paying less commission? I don't know that that's really what is going to happen from this, but we have hit a new record, you guys. Nationally, the record of 8.5% of homes in the US are worth $1 million or more. I highlighted an article last week talking about how Phoenix became part of the $1 trillion club, where the aggregate home value throughout Phoenix is over $1 trillion, and we're one of 8 metros that have seen that. Now we're getting this news of, 8.5% of homes are now over $1 million throughout the country. Nearly 1 in 10 U.S. homes are worth $1 million or more. That's the highest share of all time. It's up from 7.6% a year ago and more than double the 4% share before the pandemic. In this analysis, Redfin's looking at figures that represent June 2024. In raw numbers, there were 8 million U.S. homes worth at least $1 million in June 2024. And last year at this time, it was about 7.1 million homes. Back before the pandemic, it was only 3.4 million homes. So no surprise there. We have seen such a big increase in home values, and to see such a large percentage of homes hitting that $1 million mark, it makes sense why, another one of those articles that I shared was talking about how the starter home is $1 million in a number of cities across the US. This goes on to talk about how prices are rising despite slow home buying demand because of a supply shortage. So it's the same story that we're always talking about. The inventory is really not at that point where we're going to have an oversupply and not enough demand, although people anticipate us getting there or have said in the past that we should be there by now, but that's a story for another day. As of right now, that inventory shortage is really just keeping us where we're at and continuing to push prices up. And that's nationally. That's not just here in Phoenix, although I think the Phoenix metro area does see that a little bit more than some other areas in the country. They say there are more million-dollar homes than a year ago nearly everywhere in the US, but there are a few metros where that's not the case. It actually fell in Austin, Texas, where 10% of the homes are now worth $1 million or more, down incrementally from 10.1% last year. Okay, not a big change. Stayed the same in Indianapolis and in Houston, but everywhere else, they saw an increase in that number. Then, of course, we have California, which is no surprise. They're gaining million-dollar homes faster than anywhere else in the US. Anaheim, with 58.8% of homes now worth at least $1 million, up from 51% a year ago. The next biggest increase in San Diego, 42.6%, up from 36.5%, and LA, which hit 39.3%, up from 35%. None of that is shocking information, but it is pretty crazy to think about how more than half of the homes in some of those metros are worth more than $1 million. Now, of course, we're going to talk about mortgage rates and what's going on in the economy, but I did mention we're going to talk about investor purchases. So let's get into it. Investor home purchases post biggest increase in 2 years. This is also from Redfin. So they're speaking about this nationally, but we're going to check on the numbers here in the Phoenix area as well. They're saying investor home purchases rose 3% year over year in the second quarter amid strong demand from renters, many of whom can't afford to buy homes. So I find that interesting because we have heard a little bit about the rental demand going down. This is saying that there are many people out there who can't afford to buy, so they choose to rent. Therefore, that rental demand is kind of gaining traction. Investors bought 1 of every 6 U.S. homes that sold, purchasing $43 billion worth of properties, and 1 of every 4 low-priced homes that sold. Now, I know a lot of people, this might trigger a lot of people out there because they hate the investors who have bought so many homes and increased home prices throughout the US. And so to see them coming back into the mix pretty strong is can be a concern. But I will say, if we look at this here, 3.4%. I mean, we're coming from a place where investors really weren't purchasing that much at all. Obviously, these gray lines here, and now just kind of coming up above 0%. So it's not a huge change. We're probably just coming back to a little bit of a normal spot, obviously not getting back to these heights. Investors purchased $43 billion worth of homes in the second quarter, which is up 13.7% from a year earlier, and also the biggest gain in 2 years. So here in Phoenix, where we see a lot of investor purchases taking place, it hasn't changed that much. So if we look at what's been going on in Phoenix, we are seeing in Q2 of this year, we had about 13.1% investor purchases. I'm also going to include in the iBuyer purchases because those are investors as well. So in total, we're at about 14.5% investor purchases. Going back to Q2 of 2023, we saw 12.2% investor purchases plus 0.5% iBuyer purchases. So year over year, we've seen about a 14% change here in the Phoenix area, tracking kind of similar to what Redfin is saying. Now, we'll see if this continues to increase. Just true investor purchases are actually down just slightly from Q1. And then from Q4 of last year, we were at 14.6%. So it'll be interesting to see what Q3 says, but that is what is going on here with investor purchases. Now, let's chat about mortgage rates and the economy. Before we jump in there, if this is your first time here, make sure you consider subscribing and sharing this with someone who might be interested. I'm here every Tuesday talking about real estate and the Phoenix market. So mortgage rates last week ticked up slightly as investors eye rate cuts. Very slight uptick. We're not to where we were a few weeks ago, thank goodness, but we didn't see those big drops that we've been seeing for the last couple weeks. Rates rose slightly from the previous week. Investors continue to expect the Federal Reserve to cut interest rates next month. We're around 6.49%. Ish from 6.47% the week before. Again, this article came out at the end of last week, so there could certainly be some changes as markets start to move this week. According to Mortgage News Daily, they're talking about how the Fed this week is meeting in Jackson Hole. On Friday, they are going to basically give us some commentary on what happened over the week and a little bit more detail on what they may be doing with the September meeting. It is anticipated that they'll be cutting the rate by about 25 basis points. This says the bond market briefly traded rate cut probabilities to the 75 basis point range for the September Fed meeting before rapidly shifting back to a 25 basis point expectations. We've had compelling data on both sides of the argument with distinct differences between inflation and labor market indicators. With the first rate cut seen as virtual certainty next month, it's just more of what will that rate cut actually be? And so there's some more info that we're going to be getting, another jobs report and CPI. So I would expect Jerome Powell to really not be too definitive on Friday when he speaks, but still talking about how they will cut rates come September, but probably still slightly data dependent, knowing that we're still going to get some more information before they make that final decision. Now let's talk about recessions, because there has been a lot of talk over the last couple of years. Are we in a recession? Will we be in a recession? How soon? Are we already in a recession? This is saying recession mentions are near a 3-year low for corporate America. So they actually were tracking the number of corporate companies that are talking about recessions, and from June to August, just 28 S&P 500 companies mentioned recession on their earnings calls. This is according to some new data, and that's well below the 5-year average of 83 companies and less than the 10-year average of 60 companies. So if we think back to 2022, when we were really in a bad place with inflation and the Fed decided to start hiking the federal funds rate, and everything really kind of slowed down, there was a lot of talk about that throwing us into a recession sooner than later, or that we were already starting to get into one. And that discussion has really continued over the last 2.5 years, to where some people believe that this is imminent, others believe we can achieve this soft landing, and some believe we've been in a recession the whole time. Now, there's also another side to this, of course, a political side that I don't want to get into too much into this channel, but are we maybe not going to talk too much about this until we figure out who's in office? There's a lot riding on this, right? So, to each their own opinion on that, but according to the data, these mentions of recession on the earnings calls has fallen significantly from levels in 2022, which is some good news. So we'll see what happens from here, but that is the news on the recession front at a very high level. Let's talk about Phoenix. Okay, we're looking at the Cromford Market Index as we do every week. As a reminder, this is an index that tells us about supply and demand in the Phoenix market. Any number between 90 to 110 is considered a balanced market, and here we are at 99.9. If you'll notice, this went up very, very slightly since last week. So we are actually starting to gain some more strength back into the market, and you'll see some of that in the next chart that I show you with all of the major cities. Demand 73.6, so that is about 27% below normal. Supply 73.7, 27% below normal-ish. Both of those very close, supply and demand, so that puts us in a balanced market. Now I think we're going to start climbing a little bit closer to 100, maybe over 100. We'll see. But when we look at the chart of all of these cities, on average, the change month over month actually slowed down once again. So we've been seeing about 3 weeks of this change in the direction that is favorable for buyers. We see that slowing down. They only changed about negative 0.1% this last time. The week before that, it was negative 1.8. And before that, I can't remember, but I want to say we were like negative 2 or 3. So every week we've seen less and less negative change. Fountain Hills has seen an increase in their CMI by 12%. So this means that Fountain Hills moved in a direction favorable for sellers. They have either more demand or less supply, making that a little bit more advantageous for a seller in that market. Chandler, which you'll see on the contract ratio map that I'm going to show you in a moment, has gone down by 12%. So they are definitely softening a little bit. Overall, we have about 9 cities showing a decrease. The rest had an increase. Anything, again, over 110 is a seller's market. So Paradise Valley up to Fountain Hills, all considered seller's markets. Our balanced markets are Peoria, Tempe, Cave Creek, and then buyers markets are Goodyear down to Buckeye. So let's look at this contract ratio heat map. So what you'll notice is Chandler is no longer a warm color. It is green all throughout the East Valley now, Chandler and Gilbert and Mesa, where we used to have a few zip codes in Chandler that were yellow and previously were red, but very, very, in that balanced market now across the East Valley. We still have a couple warmer zip codes, but overall we're seeing a lot of green here. Let's for funsies, okay, you guys, let's go back a month and let's just see the heat in the market a month ago. July 13th. See? Many more warm zip codes. So overall, we're seeing this cool off in these zip codes. Now, you're probably like, then why are we seeing these green arrows here and all of this strength? These are cities. Okay, so this can only be measured by city. They need enough data to be able to create the CMI. These are zip codes, so zip codes can change a little bit more. Contract ratio is much more recent and timely than the CMI is going to be. Maybe I shouldn't say much more, but it's going to be a little bit quicker to react because they're just measuring the number of homes for sale on the market that are available and how many of those are actually under contract. So it's that ratio between active listings and under contract listings, which shows us the inventory and then the demand that's absorbing those. So you're going to see seasonality with this contract ratio. You're also going to see a little bit more volatility with it too, just because it's we're getting kind of that real-time data or as close as possible. So that is the difference there. Now, of course, if you want to know more about what's going on in your particular area of the valley, I have a really cool tool that's a market snapshot. You can just check the description below, click that link, and it will give you the snapshot of the market if you put in your zip code or your city. I have other resources as well if you want to check those out for buyers, sellers, or investors. And don't forget to come back next Tuesday to join me on that market update. Have a great week.